everybody. Welcome to today's edition of the 1Mby1M podcast. I'm here today with Vivek Ladsariya from SineWave Ventures. Vivek, welcome to the show.
Thanks. Happy to be here. Thanks for having me.
So let's start by introducing our audience to you as well as SineWave. What is your investment focus? How big is the fund? Let's just get acquainted.
Excellent. Yeah, we are a fairly new fund. We are bi-coastal, based out of DC and California. SineWave Ventures, at SineWave, we invest typically in seed to B stage companies, mostly in the enterprise software space, but also some companies in what we define as the applied technology space, companies in financial services, healthcare, transportation, and the likes. And we work very closely with our entrepreneurs, trying to help them bridge the gap with large enterprises and the public sector. We see a huge opportunity for early stage entrepreneurs to both sell into those verticals, but also in some occasions navigate from a regulatory standpoint. And that's what we are trying to work with our portfolio companies towards.
And how big is the fund?
We're just over $60 million.
Okay. And what size investment do you like to make?
That varies. As I said, we are a seed to B stage fund, and in the seed stage, our check sizes are slightly smaller, maybe in the $500,000 to $1 million range. That expands to the $3 to $5 million range at the Series A and Series B stage, where we'd either lead or co-lead or follow on and around, depending on the structure and the dynamics of the company at that time.
And let's double click down a little bit on what your definition of seed is. What do you like to see in terms of validation? Since your focus is enterprise software, what do you normally like to see in terms of metrics for a company to be interesting for you to invest in the seed stage?
Yeah, I think that's a great question, because the seed stage has become so granularized that I think that there are various different stages of seed. What we are typically looking for is, there needs to be a team that understands the technology well and the space well. And I think that's a least common denominator for most VCs in the seed stage. I think everyone's looking for at least that. What we need in the team, I think very specifically, is entrepreneurs who are in that space for a specific reason, not just the current noise in the market around that space. So people who've been working towards problems in that space for a while understand the challenges well. As far as traction goes, I think that there are some revenue metrics that we look at. I don't think it's as easy to pinpoint across the entire sector. I think different companies still have different dynamics that they need to accomplish, but we do need to see some kind of market traction, some kind of customer interaction. A lot of companies that we've only done a handful of seed deals so far, and those tend to have some kind of pilot interaction with a few customers, maybe one or two of those pilots close to contract or moving towards a contract.
Okay.
I'm sorry that's not more specific, but I think that tends to vary with companies in different stages and the kind of product they're selling. So companies that are selling products in the computing space, where an average customer might be in the $30,000 to $50,000 range, we expect to see at least a few customers bringing the year-to-date revenue to somewhere over 200,000, but an annualized run rate of maybe close to $1 million. And that might vary for a business that really is trying to sell contracts that might be a couple of $1 million, where we don't expect to see a fully baked out contract, but the company on track to doing that.
Mm-hmm. And what about geography? You said you're a bi-coastal company. Do you invest all over the United States, or just on those two locations where you are located? What's your sweet spot?
Yeah, so far we have companies all across the U.S., California, Boston, different parts of the East Coast as well. Although we aren't tied to that, I think we are looking for companies in the U.S., but also potentially outside. We have looked at companies coming out of Israel, Latin America, and the likes. But so far, we've invested in companies in just the U.S.
And let's take a few companies from your portfolio and double-click down to understand what you've invested in and how do you decide what to invest in. So give us a few examples, highlights of your portfolio, and also take us through the process of understanding how you've decided to invest in those companies.
Sure. So I'll start a little bit on the second part of that question on how we decide what we want to invest in. There are two components to it, but I think we like to call ourselves a thesis-driven fund. So we do have a worldview around certain technologies and certain industries, and we come at companies from that position. So we tend to look at companies where we believe that the problem is a real problem, and the solution that the company is offering can actually try and solve that problem. Diving down there, I think we recently invested in a company called Jump Bikes, where one would have argued that urban mobility was a solved problem. We didn't see it as such. We thought that there was a lot still to be done there. I think Uber and Lyft have obviously captured all of that market and solved most of the issues there. But I think there was still some work to be done in small distances in very high density urban areas. And there's a lot of noise in that segment today. I think we were seeing a flurry of scooters and bikes getting into that space. But I think referring back to something I spoke about earlier, what we look for in a team is a team that really understands the problem in the industry, and Jump had that team. Ryan, who's the CEO of the company, was an urban planner in New York for a while. The company, he started Jump, which was back then Social Bicycles, in 2008. So sort of well before any of this noise started around, he really does truly understand the challenges, and the entire team that was built around there also did. And when we spoke with them, I think we thought that was the team that was going to carry this problem through and really develop a solution that works for all stakeholders, not just customers. I think a key stakeholder that inexperienced entrepreneurs and entrepreneurs who haven't really spent time in this space tend to ignore are cities. And the part of the reason why Jump was successful or is successful is that they work very well with cities. They know how to play nice. They know how to develop that relationship and try to address problems rather than play in an ideological bubble.
And
sorry, I wanted to pause there to see if you had questions on that.
Yeah, when they came to you, what was in the company? What did you see in the company that was already proof points, besides the fact that the guy understood the industry?
So when we invested in the company hadn't completed its launch of its new product called Jump Bikes. It was still Social Bicycles at the time, and they had experience of operating that business in several locations, I think across countries, not just in the U.S. That they were in several dozen countries across the world operating social bicycles, primarily working with governments. So the business model then was, getting space from government, getting contracts from governments, and deploying bikes so that people in the city could use it. The idea behind launching Jump Bikes was they had developed this new product, which was an electric pedal assist bike, and believe that was far convenient solution. Although it was a new product that the company was trying to launch, this team had experience and had proven that they know how to deploy bikes, they know how to operate bikes across cities, they know how to work with city governments, and whatever element they do not, we were going to be able to help them with city government.
I see. So they were basically in the incarnation that you funded. The thesis was that they were going to sell these newly designed proprietary bikes to cities and also manage the process of renting out bikes to the citizens.
Right, and that played out in San Francisco. I think when we invested in them, they still did not have their exclusive license to operate in the city of San Francisco. They then got a distribution agreement with Uber to distribute, and I guess it's been in the press lately that they've been acquired by Uber. So yeah, it was. I think it was a very well-defined thesis for us, very well-defined argument for us going into that investment, and a lot of that played out in a very short time for us.
And when did you invest in this company?
This was a round that was announced in January. I think it was completed late last year, but the round was announced in January 2018.
I see. And it's already acquired?
That's correct.
I see. So what's the total amount of funding to exit ratio? How much did you put in, and what is the exit price?
So the total amount the company raised was a little over $10 million, I think somewhere in the range of $11 million. The exit size wasn't announced by Uber and the company, and I think I'm going to respect their process there to announce it when they need to. But it was a good exit for all around the table, investors, team included, and most importantly, I think it's from the team standpoint and the investor standpoint, the ones that were in the company believed in that problem. And at Uber, I think they have a good home. They know that they're going to be able to build it out, and it looks like it's a key issue for Uber. They recently, I think just yesterday, they announced that they're going to go into more modes of mobility, not just ride sharing, and bikes is going to be key for them in cities.
Let's do a couple of other examples from your portfolio, just to understand how you think, and then I'll try to synthesize that.
Yeah, a more typical investment for us, we recently invested in a company called Rescale, which is a high-performance computing company offering simulation to cloud simulation to enterprises. And this is a Series B investment that we did in this company. And our view here was, I think, as companies, as enterprises tend to launch and work on new products, it's going to be very expensive building simulation platforms themselves in-house and doing it on-prem. And Rescale was offering a platform to do just that. And it was going to be a key product for anyone really launching and working on new products. They've had success doing that across a variety of different verticals, ranging from aerospace to automotive, and even in insurance and healthcare. This one, I think that there were more reasonable, fairly traditional SaaS metrics that the company had, and that we were going after. But I think as investors, and I believe most investors would say, I don't think we're just investing in metrics, but there's obviously a vision that we believe in and see this company getting to a point where it's much larger than what those metrics suggest today.
And what are the specifics of this? So how much money had already gone into the company, and what were the metrics against which you invested a Series B?
Sure. Yeah, the company at that time had raised a Series A, and it was a traditional size Series A, so somewhere in the $10 million range. That they had grown to, without diving into the revenue, that they had grown to over 120 enterprise customers, paying decent amount of money. And I think what was interesting in that, in traditional finance, people talk about quality of earnings. Although there aren't very specific earnings to talk about here, what I like to call this quality of revenue, that they have very high quality revenue. By that I mean it's not just one industry, it's not very concentrated on one customer. I think it's across several industries, so they prove that their product can really scale widely. And it's not just useful for one customer, it's useful for several customers. And finally, and most importantly, for almost all of those customers, the revenue had been growing even within those accounts. So I think a lot of those customers had started out with a certain amount of money allocated to this, running simulations, and over time that grew significantly. And all of those were good signs to us.
Mm-hmm. And can you talk to me a bit about how you view TAM? And I'll give you the context of where I'm coming from in asking this question. We are in April 2018, so lots of stuff have already been built. Nowadays, there aren't as many wide open opportunities out there to build these billion-dollar TAM businesses. And you know, some people believe that they want to only invest in $10 billion plus TAM opportunities and so on and so forth, which are even fewer and farther between. But I actually see that there are many, many niche opportunities out there, and some of these businesses need to be built for small amounts of capital. You know, whether it's the $200, $300 million TAM opportunities or $500, $600 million TAM opportunities, or even in some cases smaller, where you build companies for, you know, 1 to 2 million, sold for 10 to 15 million, still make 10x, still make, you know, good returns. How do you view, what is your TAM perspective? What is acceptable to you? Because your fund size is still small. It's a $60 million fund where you could be playing in the niche opportunities and seeking early exits. And it sounds like in the case of this Uber deal, you have done exactly that. So can you reflect on how you view TAM?
Sure. So I think there are a couple of things that you brought up there, which are, I think, very important, and I'll address. The first part I don't necessarily agree with. I don't think we are at a time where that there are not a lot of the big opportunities are already done or covered. I think the nature of the market that we're in today is very similar to what the market's been like for a long time. I think that there are what seem like small opportunities tend to grow, and that I think with every major breakthrough company we've seen in recent history, it's been that way, where initially it seems like a very small company, very small TAM, and then the company tends to grow from there on out, branch out into peripheral areas.
That's not my point. That's not my point. My point is that we have a very large number of micro VCs and small VCs out there right now. That number has exploded to over 700 just in the last couple of years. And I just don't believe that if everybody's chasing unicorns, it's going to be possible to find that many unicorn opportunities. Unicorns by definition are rare. So it's just not viable.
And which is what I was going to say, that the second part, which was that you were mentioning, I strongly agree with. I think it's true. I think it's especially for a smaller fund, the idea for a lot of smaller funds is it tends to be invest in things that can return decent amounts of capital, so that you can raise larger funds if that's your objective. But I think smaller returns, there is absolutely no shame in $100 million exit, and $100 million exit can be great for early investors, great for founders, great for teams, and investors, LPs should be happy as well if the multiple is good, especially if you did a deal at the right price, at the right size. So I absolutely agree. I think there is no shame in that, and I don't know. I haven't spoken to investors about this. It might be that investors don't vocally agree to this, but I think every investor would be happy to invest in companies with that outlook. Obviously, I think every investor wants the massive exit. Every investor wants to have invested in Dropbox, but I think smaller exits are as good, especially because from an IRR perspective, smaller exits tend to happen quicker and happen earlier, and you can return a higher IRR to investors. And just going back to the TAM question, I think for most companies, I think even when we invest, and for every company growing into becoming something like a Dropbox, there invariably comes a time when the company is evaluating a mid-size exit or a funding round to go it big, and I think that's a situation that everyone faces. And and a mid-size exit could be great, and going it alone and trying to grow big is just additional risk at that time, which maybe smaller early investors are not often do not want. So I think it is a nature of the time.
So I think the synthesis of what you said is that you are open to the smaller capital efficient investments and earlier exits.
Oh yeah, absolutely. I think in general, regardless of what size of a market we're going after, we need our entrepreneurs to be capital efficient, and I think that's generally healthy, even if you're trying to build a massive business. Because in order to raise the next round, if you're capital efficient, you get to get your milestones more efficiently.
Totally agree. And two of my favorite unicorn companies actually are Viva and Fortinet. These are two incredibly capital efficient companies that are today, multi-billion-dollar market cap companies. Viva, in its entire history, raised, I think, $7 million in capital, of which $4 million never was necessary. They just had so much revenue and so much momentum that it was basically a company built with revenues and traction and just tremendous product market fit and tremendous execution. Fortinet also was an incredibly capital efficient company that scaled tremendously and today is over 1.5 billion, I think, in revenue and a tremendous market cap. So even when you're talking about unicorns, I prefer this kind of model.
Yeah, no, I agree, and I'll add Salesforce to that list as well. I think it not as capital efficient as Visa, maybe, but I think that they weren't that they did not raise the kind of money a fairly standard unicorn might have for their size.
These days, that's a recent phenomenon. Well, I think, in some sense, Salesforce did not raise as much money, but if it did, it would be more justified because they created the cloud market, right? There was a tremendous amount of pushback on cloud when Salesforce came into the market. People were not willing to put data on the cloud, and they made the market happen. So that those kinds of deals can be much more capital intensive as opposed to capital efficient, but even so they did not make as much, they did not spend as much. Whereas nowadays with the market, the cloud market is ready. Everybody today assumes that it's a cloud deal. Then why are people raising so much money and being so capital inefficient and so callous? I don't like these kinds of deals at all.
Right, I agree, and I think a little bit of that is trying to use money to capture market, which I obviously is not sustainable. Anyone with half a brain can say that, but I think the deeper issue there is often you run into entrepreneurs who are in it for the wrong reasons. So
right.
Trying to get your chips off the table or get a payday along the way, and I don't think that's the kind of an entrepreneur we are trying to back in general.
Yeah. Okay. So last question. In the last, let's say 15, 16 months, what are the trends in your deal flow? I'm sure you've seen a lot of deals. What stands out? Besides AI, everybody talks about AI. We know that AI is one of the dominating trends of the current cycle. What else do you see? Blockchain and AI are everywhere.
I guess deal flow trends also tend to vary from fund to fund based on team backgrounds and what your history in investing is. But I think smarter entrepreneurs tend to dive deep into that before approaching investors. So a lot of our deal flow tends to obviously be in enterprise tech. We've made quite a few security investments, and we tend to talk to a lot of security entrepreneurs.
Security is an interest area for you.
It is, yeah. So within enterprise, I think a few areas that we tend to focus on quite a bit is computing, different kinds of computing. I think computing is changing from becoming a fairly generic processor for everything to very hyper-specialized kind of chips. And even in the cloud, security is key for us, and different kinds of data processing and the likes are important to us. And since those are what are important to us, both our outward marketing, outward kind of deal flow generation, and our inbound deal flow tend to be in those worlds. But I don't think that's representative of the broad trends in U.S. tech or California tech. I think that's very specific to what we tend to look at. And that's
in the venture cycle, enterprise software is a tremendously important and active segment. It has always been right from the beginning of time, and it will always
Absolutely.
It will be at least for the foreseeable future. So within enterprise software, cybersecurity does continue to be a great trend, and it has always been. Actually, cybersecurity is probably one of the consistently active areas of venture investment, again, from the beginning of time in the venture history now.
Yeah, and that's just because it's such a massive, ever-changing problem. I think
the
issue is, I think, the nature of threat and malicious players, that they keep evolving so much with technology that I think technology needs to continuously keep evolving. And we are fortunate to be able to see good deals in that world. Obviously, of late and recently, we've seen a lot of deals in the mobility space, partly because of our investment in that space, partly because I think there is just a lot of activity there. And some amount in various financial services. A lot of that, though, is a lot of what we tend to find interesting there is more international facing, because I think that there are a lot of things in international markets that are still unsolved that might be solved here in the U.S.
And what is your presence or activities or interest in the healthcare space? That's a very high potential space right now.
Yeah, I mean, we strongly believe that the U.S. healthcare market requires a lot of changes, and I think a lot of it is going to come from the tech world, largely because I think tech traditionally has been fairly consumer focused, and U.S. healthcare hasn't been. So I think that the tech approach to that is going to come soon. We've been exploring this space for a while. Health operations, I think, is a space that requires a whole lot of tech analysis, and the likes can make that far more efficient. Insurance is something we've looked at, largely because I think insurance is broken as far as incentive alignments go with providers and consumers. And so yeah, I think that there are a few different things we've been trying to play with in that world.
Okay. All right. Well, that's a good introduction to SineWave for our audience. And we will look forward to working with your firm going forward. Thank you for coming to the show today. And audience, thank you for listening. Remember, as we always emphasize, on the website at 1Mby1M.com, you can go to free public roundtables and register to pitch or attend at any of our free mentoring sessions. And these are working sessions where you can bring your projects so that we can work together in figuring out what your roadblocks are, what your strategy situation is, and give you feedback. So we'll be back with another edition of the 1M by 1M podcast. Thank you, Vivek, for participating, and we look forward to working with you.
Thanks for having me.